Okay. Thank you, Jite. Hi guys, welcome to, this is our last webinar on the 12-week Enterprise Toolkit program that you've enjoyed so much, which has really totally transformed your ideas, transformed you, transformed your businesses. And you know that the last 2 weeks you've been assembling all your learning from the 10-week modules into a business plan, and we're going to be discussing that. But I think before I move on to that, I just want to remind you that those 10 modules, or the 12 weeks, certainly the 10 modules, are tools that are going to sustain and support you, not only just in this business, but other businesses. And I hope that you will go on to set up, but also this particular business with which the business idea that you applied to and you were selected for the program, that this business is going to evolve. It's going to get bigger and bigger and bigger. And those 10 fundamentals in the business plan that you've gone through are going to remain throughout the growth of your business. So my advice to all of you is go, if you haven't downloaded them, please go and download them so that you have the copies on your own. So you have copies on your own system, and or I'm an old lady and I like to have, I'm from the analog age, and for me paper is still a very important commodity, and I think so you should go and print copies of those, go and get them printed, get them bound, put them into your folder so that you can refer to them. And finally, another thing that many of our entrepreneurs 2015, 2016 have done is to also then share that knowledge with others, that they've maybe adapted that particular 12 weeks and shared that information about the 10 fundamentals to developing your business, to really developing, a roadmap or a plan for your business. Yeah, from an idea to an early stage enterprise. Yeah. So anyway, so I launched straight into it, but that's really, really, so welcome. You know who I am. Parminder there. I'm joined in this webinar by Binta, by Jite, and we have a special guest, Omar Rumi, who is a management consultant at Accenture. You know that Accenture is a very important partner in this program. They are the ones who basically review and select and propose a selection of 1,000 plus entrepreneurs from the applications at the beginning of the cycle. And they also are critical in terms of that, the last 2 years, they've also been responsible for the business plan reviews, and they have learned. So they actually do a very, very deep dive into your business plans in a way that really the foundation does not have the resources or the skills to do. And they have identified, certain weaknesses in the business plan based on those 2 years of experience. And we met with them and agreed to host this webinar, invite them to this webinar, so that you can present the strongest, the best business plan that you can write. You're not writing the business plan to pass a test. You're not writing it to please Accenture or the foundation. You're writing a business plan which is works best for your business. Yeah, it's your business plan that you're going to take to potential clients, potential partners, potential funders, possibly. Yeah, potential. When you're negotiating anything, anywhere. That business plan is an important document that you will take as where you've objectified your business. Yeah, you know the numbers, you know the people, you know the different milestones, you know how much it's costing you to run the business. You know that information. Yeah, and that is contained in the business plan. And she's going to basically step in after I've gone through some, just reminded you of some of the deadlines and also gone through some of the questions, frequently asked questions, which now run into pages and pages of it. You want me to go through all of them? Wow. But then I think maybe we'll do the webinar, because I think the important thing is that they go through that and then we can go. So I'm just going to go, just to remind you of some of the key dates, right? So Sunday the 30th of July, that's this Sunday, is the last of the 12-week program. So you have to complete, all your tasks have to be completed by Sunday the 30th of July. Your business plan has to be submitted by the 7th of August. Yeah, so that's a deadline you should all know and meet. Business registration, you know that we are, you may have applied as just an idea, but by the time you graduate, by the time you finish the 12-week program, you need to have also completed your business registration. And the deadline that we have set is by Friday the 11th of August, where you then share your business, the certificate, verifying that you have a registered business. Yeah. If with Binta and Jite's permission, I think I'd like to move really to and really move it to almost really really share with us, and I'm going to sit and listen to it. Basically, how to really present the strongest possible business plan, so that when they come to review it, they're not that they take this very in your business plan, and that particularly address the weak areas in the business plan, which I know even without any surveys, because I've written business plans myself and run businesses, is the financial component of the business plan. So I'm going to hand you over to Uma. Uma, are you going to come in here? Oh, okay. You sure? I'm going to. Oh, okay.
Good afternoon, everyone. So I am going to.
Can I stay here? Okay.
Good afternoon, everyone. So for the next 45 minutes, I am here to basically talk you through the financial projection section of your business plan. So Camila has spent a bit of explaining why this is important for us as entrepreneurs. So the reason why we're having this webinar is to explain the significance one more time, explain what the financial model template, the one has been provided by the TEF team, what's about, and how you can populate your template so that you submit the right financials for your business. Okay. So we have our agenda for this webinar showing here. So I'm going into the overview, and first thing I want to say is that it's a thing for you to do while you're developing your business plan. Once you've developed identify the products and service that you want to offer, you analyze your business environment, and then you determine how you're going to operate, how you're going to create your service, advertise it, and sell it. The very next step, the very logical next step to take is to estimate how money will be earned, spent, and used in your business. So this is an important step for you to take as an entrepreneur, because it convinces your investors, it convinces your partners, your potential partners, that you have you have a business plan, a business idea that is going to be financially successful, and it shows that it brings about the right level of confidence for your business. So, because in the interest of time, I'm just going to go straight into what the financial documents look like. Typically, you're going to be expected to generate three types of financial statements, three types of financial documents. The first one we're going to talk about is the income statement. So the income statement basically answers the question, how is the business going to make money? Is your business going to make profit? So it shows a summary of the revenue. That is basically the money that you've been able to get into your business through sales, and the expenses you've incurred in your business during a specific period of time. So as one of the requirements as a TEF entrepreneur will be to create a schedule of what your income statement is going to look like for the next 3 to 5 years. And basically what is communicating to anyone that is looking at your business is whether your business can make money or not. The components of your income statement, this is pretty straightforward. We have a table here. Your expected revenue consists of your cash sales and your credit sales. So you input that number there, and then you have your cost of goods sold. This is done in a systematic order. You first put in all the revenue that you're expected to gain in your business for that year, and then you deduct the cost of selling. After deducting the cost of selling comprises mainly of your raw material cost and the cost of direct labor. And then after you do that, you then deduct every other cost associated in running your business on a day-to-day basis. That's your administration cost, your cost of utilities, electricity, water, internet, your cost of insurance, your cost of transporting your goods to customers, your advertising cost, your travel expenses, your insurance cost. Once that is done, you then deduct interest expenses. That's if you have taken out a loan or you have any legal obligations that you have taken out, and the interest payable on those obligations, you then deduct that, and then you go to you deduct your income tax expense for the year, and the final number you have after that is your net income or net profit. So once you've done this, the first thing we want to note, so this statement is basically telling us if your business is profitable or not, and it focuses only on the inflow, the revenue and expenses that you incur in your business in the course of 1 year. Next statement, which is the balance sheet, then shows us what kind of assets and liabilities and equities you have in your business at a specific point in time. So this statement is answering the question of growth. Will your business grow over time? So the previous statement was just showing the revenue and expenses at particular points in time. But the balance sheet, the size of your balance sheet, the net worth year on year, will be expected to grow. That's the kind of confidence that you want to give your investors or your partners, that your business is growing year on year. And in your balance sheet, you're going to reflect your current assets and your current liabilities. You're also going to reflect your fixed assets and your fixed liabilities. And I've shown the breakdown of what this entails, your current and fixed and long-term. And they are also affecting your shareholder equity. Shareholder equity basically consists of money you put into the business, that's your paid-in capital, money that you're going to get from investors like the Tony Melu Foundation, and retained earnings. Retained earnings is usually your net income, whatever you pay in your business after, at the end of the year, after bringing in all the sales, and after deducting all the costs to all the expenses involved in running your business. The next statement. So, and then the third cash flow statement. Okay, the third cash flow statement then focuses on how cash flows in and out of your business. So it's answering the question on how liquid is your business going to be. So it's one thing to make profits, and it's another thing to have a business that has supplied a service. Let's say you supply services, a business person, you supply services to other businesses, and you supply the service, and you manage to spend less money in supplying. than what you've been able to gain. So imagine you're going to pay $2,000 for the service you're supplying, and you manage to provide that service using only $500. So that means you're able to get $1,500 at your money. You are profitable. But if that customer does not send in that money on time, it means that you're going to have issues with cash flow. And having issues with cash flow is problematic for young business, because it means that if you have to buy raw materials, if you have to pay your employees, you're going to run into problems, even though you're profitable. So your cash flow statement gives a sense that you understand how to balance the inflow and outflow of the money coming into your business in such a way that none of your business activities are impacted by any outflow of money in your business. So, given this background, if we have any questions on what I've said, you could type them out, but I'm just going to go straight into the benefits of why we do this. So we're having a session partly because it's a requirement. It's expected when you're developing a business plan that you develop a financial plan. There are also benefits to you as an entrepreneur in doing this exercise, in projecting your financials. The first thing is that it helps you confirm that your business is financially viable. Yes, you have a beautiful idea, but by the time you consider all the money that would come in from that business, the cost of how much you can gain from selling your products, and then you consider the amount of money you require to produce that product and sell it. I think we are back. Yes, I think we are back. All right. So what I was saying, all right. And it helps you confirm that your business is financially viable. So it helps you put all your numbers together, the cost of delivering whatever product or service that you're going to deliver, and the cost you're going to get from, and the money that you're going to be paid to do this. It helps you put it side by side and determine whether you're going to have enough money at the end of the day, whether the whole venture will be worth it for you. And the next thing another thing it helps you to do is that it helps you determine your business model is sustainable. So it helps you have a sense of the cost you have, your cost of doing your business year on year. Is it going to become so much that it's going to erode into your profits, and then at the end of the 5 years down the line, you find out that you don't have any money that after you put in so much into the business? It helps you answer that question. So it gives you the opportunity to look at all your costs and then determine whether a particular cost item can be removed or can be reduced, so that you don't end up having any problems down the line, any problems of cash down the line. And the next thing it does, what I say, is that once you have a table showing your revenue and your costs, it can help you identify the levers that you can pull to improve your profitability. So if you notice there's a particular cost that is not adding so much, but it keeps eroding your profits year on year, you can easily remove that or reduce it. And then the last thing it helps you to do is to anticipate potential financing challenges that you might face in the future. So if you realize that in a particular period you are going to run out of cash, you can easily decide whether you want to take out a loan, or you want to seek for equity in that period. So it helps you do a lot of long-term planning. So that being said, okay, all right. So I'm going to pause now, and I'm going to pause now to take a look at pause for 5 minutes before I go into the next section, because the next section is going to be a walk through the template. Already I can see comments on the template and related questions around that. So if you have any additional questions, you can take time to type them below. And if you have any questions on what I have spoken through so far, you can also type those below as well, so that we'll take that as we go through the walkthrough. Okay. Okay, so the first question that says, is our business plan going to be restricted to 10,000 as what TEF is providing on it? Okay, so I'm sure you understand that you're getting a seed capital of 5,000 this year. So if you're doing any projections this year, and it's going to come in pretty late into the year, so it might not be wise to do any projections this year anyway. So your next year projections will take into consideration the 5,000 that you're getting, and then future year projections will take into the other years, the other 5,000. It may exceed that irrespective. If you're expecting any other inflow of cash of equity into your business, you can also put that. You can also map that out in your financial plan. So we're not looking out for whether you put in the $10,000. We understand that you might also have other sources of equity. So if you map that out, all of that should be reflected in your financial plan. So the tax rate, as a question in assumptions, has not specified its tax. It's your income tax. Sorry. Jamilu Waziri. No, okay. Joseph Umo, your question on tax rate. That tax that is being requested for is your income tax. So please take note of that. Financial assumption document doesn't give this. Okay. So I have a question around how do you reflect your variation in volume and pricing in the assumptions tab. So we understand that for certain businesses, because of seasonality, you might have to review, you might have to plug, and that cannot be plugged in directly into the template. So what you're going to do is just do an average. So you know that in January you're going to produce 500 units, in February 600, in March 800, on and on. Do an average, divide it by 12, and put that number in. Because at the end of the day, we're looking out for the number for the year. So by the time you plug in your averages, you will end up with the final number for the year. Then the next question I see here is on startup costs and office costs. Okay, so it's not showing the digits. So those cells, the startup cost and the office template, is not showing the digits. I know why this is the case. So those cells you're referring to in that template, they have been formatted to abbreviate when you put thousands. So if you put in 5,000, it's going to show you 5. It's the programming in the template, and there's nothing to worry about concerning those numbers. And yes, there's an important question here on direct cost in producing, which we're going to get into when we get into the template. So in the next 4 minutes, we're going to go into the template work. There's a question on direct cost in producing. That is, does it mean factory worker salaries will be represented differently from production, from the salaries of other staff? Yes, that is the ideal way you should represent your cost. You should separate cost of production from the cost of sales and marketing. The labor costs involved, they should be separated, because there are certain metrics that we look out for that any person analyzing your financial statements will look out for. They will look out for your gross profit and your net profit. So it's in separating that you're able to tell the difference, show people the difference between the two. Okay. Then another question, which I'm just going to abbreviate, is that we've gotten this in years past, where people will complain that they cannot develop forecasts for their businesses because they're just an idea, they're in out, and all of that. So what I'm going to say is that none of that actually matters. The general idea is that no matter what stage you are in your business, you should be able to give us a sense of what your numbers will look like. So yes, some of you have ideas and businesses that are just in idea stage, but this is an extra effort that you're going to do for us, to show us that you really want to run this business, and that's to go and get the cost and the numbers, go to the market, go to your industry, and look at the cost associated in with your business and your industry, and plug those in to generate financial forecasts for your business. Because we want to be able to get a picture of what you're looking at. This is painting a financial picture of your business. So you need to get those numbers and generate the financial forecast for your business. Every entrepreneur will be expected to generate a financial forecast for their business. Okay, so it's I have 2 minutes left. In the next 2 minutes, in 2 minutes time, we're going to go into the walkthrough. So I'm just going to take 2 more questions before I close out on that. So financial model assumes that your businesses are dealing with a single product. So there's an assumption in the financial template that you are bringing out just one product, and then you have only volume and price. You have only one slot to put in volume and price. So what you're going to do, you're just going to, hopefully, we're expecting that your products are basically in the same range. So like for a bakery business where it's something like meat pie and cakes and all of that. So we're talking about the same range of products. So what you're going to do to work around that is to do an average of the prices of your product, and also do an average of your expected volume of those products as well. Put those numbers in the financial template. So just do an average on your range of products, and use those average numbers to plug out your expectations, your financial forecast. Okay. So business plans that have to do with providing services. Services volume is, so for those providing goods, services will be around frequency of purchase. So how often do you expect that people are going to patronize your service, whatever service it is? And so it is 435, and I'm going to go into the walkthrough for the financial template. So for those that have not started projecting their financials, and even for those that have started, there are typically 4 steps that you're going to take in projecting your financials. Just before you get started, before you start off with the template and go into the template and start putting numbers, there are 4 things you're expected to have done before you start populating financials for your business. So the first thing is to estimate all the costs that you will need to set up your business. And then you're also going to, as you estimate all the costs, you are also do a grouping based on whether they are one-time costs or ongoing costs, because you're also going to group them based on whether they are capital costs, that they are fixed assets that you're purchasing that you will not need to purchase on an ongoing basis, whether they are ongoing costs. So for whatever business you are running, basically take out time to document all the costs associated with that business. The second thing you're going to need to do is to estimate how you're going to earn revenue over the next 5 years. So you should have, and because of you should have a sense of what the price of your product will be. You should also have a sense of what the volume will be, expected volume month on month. So you're doing all these projections month on month. So in a month, how many transactions, how many customers are you expecting to satisfy, and how often are you expecting people to purchase your product or service? Then at this place, you also account for seasonality as well. So if you have, like, let's say you're a school business or a tutoring business, and you know that there's a season when children are in school. There's a season when children are in school, and then there's a season when they're out of school, and you know that you're not going to be having any transactions during those periods of time. That's basically what we refer to as seasonality. So account for seasonality in your business when you're estimating how you're going to earn revenue in your business. And then the third step, which is a check step, is to go back to your business plan, your plan of operations, your plan of marketing, and your management plan, and just ensure that all the revenue and costs that you've estimated, they reflect the impact of all your functional plans. So in your marketing plan and operations plan and management plan, you have outlined certain strategies so that you can, certain strategies to ensure that your business is successful. So you have maybe a feature strategy. So maybe you have, for your product or service, you have determined that to stand out in the market, to compete successfully, I have to add this new feature to my product, because I'm selling something that is already in the market. So I need to add this new feature to my product. So that feature strategy, there is going to be an impact on your cost. What's the cost of getting that additional feature? What's the raw material cost of transport? Whatever it is, make sure it's reflected in your revenue and cost, the revenue and cost that you've outlined. You could also have pricing or discount strategies. Maybe as a business, you've determined that for a particular season, like in December, you're expecting that you're going to have increased patronage in December, and you want to run a promo. Estimate the impact of that promo on your pricing and your revenue for December. Estimate the impact of whatever discounts you're going to offer on your pricing. So if you also have like a marketing strategy, like let's say you want to go and sell your product at festivals or fairs or whatever it is, the cost of brochures, the cost of sales reps, the cost of additional products that you have to produce for that particular initiative, for that particular campaign, ensure it's reflected in your functional plan, ensure it's reflected in your revenue. Also, your talents are up. You have something that is different from what obtains in your market and your industry. Ensure that it's reflected, and same as distribution. Now you have your revenue and you have your cost. Determine from the look of things, you will already be able to get a sense of whether your costs are going to exceed your revenue for the first 5 years of your business. And if they are you going to need additional financing? Do you want to take out the debt? Do you want to seek for additional equity? Or you want to do a combination of both? Determine all of this before you go into populating the financial templates that TEF has sent to you. So we're going to go into the first template that you will encounter when you open the TEF template. No, well, it's not the first template. The first template that we're going to talk about is your income statement template. So this, like we've already explained, is showing your revenue and your expenses for the year. And the template you have has given you a chance to populate what you estimate as your revenue and expenses from January up to December. I imagine this number that is showing 2017 will change to 2018 since it's coming later in the year. So you're probably going to start your estimations from 2018 next year. And you'll be expected to put in all your... So what I'm going to do at this stage is just walk through every line item on the template. The first item is sales, and it's simply that you're estimating how much sales you're going to expect in the month of January, February, all the way. You also have another item on reduction and discounts and shipping. You also estimate those as well. Once you do that, you would, at your fill in the template, there's also, I've put in some markers on this snapshot I have, and I put some red lines showing places that you do not have to fill. They auto-populate. They have formulas running in them, so you don't have to fill those sections. They are the places calculating your net sales, calculating your gross profit, calculating your operational expenses, and finally your net income. I've put red lines showing that those are areas that you don't need to fill, and I put the green markers showing the areas that must be filled by you. When you come to your expenses, you have to fill in your salaries and wages, fill in depreciation costs, rent, office supplies, utilities, and all of that. Now, I want to take our time, just also making reference to one of the questions that was asked earlier, that if you have your cost of goods sold is supposed to take into account your raw material and direct labor costs. And then you have salaries and wages as well. So for new businesses, where you usually have a lean team, sometimes it might be difficult separating the direct cost from direct labor from indirect labor. Like if you are a farmer, you have a farm business, the people that on your farm that are helping you plant the crops and harvest the crops. Sometimes they might also be the same people that are helping you sell the crops. But it's important to separate the cost of, that's the cost of the farm hands, the cost of those in direct production, from those that are involved in the sales and the marketing and IT and HR and every other type of cost. Those that are involved in actual production, that's the farm hands, the factory workers, the for IT business, the people involved in the back end, all those costs of goods sold. Every other person's salary and wages goes into salary and wages. So I wanted to point that out. And then after all of this, you also have sections put sections that are indicated as other 1 or 2 and other 3, where you can put in any other additional costs that are specific to your business, additional expenses that you will incur in your business. So that's that on the income statement template. This is usually one of the more straightforward templates to fill because it's basically plugging in all the numbers that you've estimated that they're going to come into your business as revenue and those that you're going to spend on an ongoing basis. So expenses are costs that you expect to incur. They're things that you have to incur and use up within the course of 1 year. So when you have things that you're not going to use up within the course of 1 year, like vehicles, like computers, like scanners, like land, like property, those are classified as assets and those are not supposed to show up on your income statement. So you would put those particular costs in your balance sheet. So as you're thinking of think through just the cost that, think through the items or the things that you would typically use up within a period of 1 year. Anything that has to be used up that would have useful life after 1 year will typically be calculated, will be accounted for in your assets. Then the next sheet that we're going to look at is the cash flow statement. The cash flow statement has very similar line items as the income statement, so we're not going to spend too much time on it. And you don't even have to populate your cash flow statement. All you need to do is to fill up the assumptions on the TEF template, and this page will be automatically populated for you. So you fill in all the assumptions on your price rate, on your growth rate, that's how you expect your customer base to grow year on year. You also fill in your expected cost of inflation on certain items, how you expect the salary cost to grow year on year, how you expect rent cost to go year on year. You have the percentages that you're feeling. So you try and make sure that your numbers are as realistic and as close to what is obtainable in whatever industry your business is situated in. Okay. So I also have sections that I have highlighted here. Even though you are not going to fill this template directly, there's some certain sections that they calculate themselves. They are total sections. So that's the cash flow from operations, cash flow from financing, cash flow from investing. They populate themselves. So I also noted the places that are showing the inflow of cash and places that are showing the outflow of cash. As I mentioned, this place you don't need to fill, you just need to populate your assumptions, put in all your startup costs, put in all your growth rates in your assumptions template, and this place will get filled out itself. And then we have the last template that we're going to look at, the last template, your balance sheet template. Now we realized over the course of the year that this template has proved the most, it's probably the most challenging to fill. So we're going to take time to walk through each item on the balance sheet and explain how it is filled. So in the template I have shown here, I have put a legend showing how each line item is going to be filled. And there's a legend that shows numbers that are coming directly from your cash flow statement. There's another legend, that's the gray, the boxes in red show the numbers that are coming directly from your income statement. The boxes in gray show the numbers that you have to calculate using a formula. And then boxes in red are the ones that have some estimation based on your business that I can't make a general assumption on. So those ones will be determined on the kind of business that you're running. Okay, so I will start from the first one, the numbers that come from your cash flow statement. So the one number that comes from your cash flow statement is what you have put in as your fixed assets. It's under fixed assets, property and equipment. So that number that you put in here, as your cost of fixed assets, you put it in your assumptions and it has come out into your cash flow statement. So you're going to take that number and put it into your property and equipment line item for the year. And if you expect to buy, that's for the first year. And if you expect to, let's say in your year of starting, after receiving seed capital from TEF, you buy a property and you buy a vehicle. And then you expect that in the year after that, another vehicle. So your first year is just going to reflect the vehicle and the property that you purchased in the first year. And then your second year will reflect those same costs, the vehicle and the property, plus the vehicle that you expect to purchase in the second year. So unlike the other statements that we looked at, your balance sheet is expected to show growth. That's why you can see that we're putting 1 year against the other year. So it's expected to show the growth of your assets and your liabilities and your equity over time. So if you have your numbers will be put in based on how you expect to purchase your assets and based on how you expect to incur your liabilities and based on how you expect inflow of equity into your business. The next one I'm going to speak about is your depreciation cost. The depreciation cost that you reflected in your cash flow statement here, in your income statement that has been reflected for the year is what is going to be reflected here as well. So that number is coming directly from what has been reflected in your income statement, what you have computed into your income statement. The next one I'm talking about is your income taxes. So everywhere you see taxation in the sheet, it's most likely referring to your income taxes. On the current liability sections, you'll be putting in your income tax payable for the year. And that's the number that's reported on taxation in cash flow statement. Also the same number that was reported as income tax on the second to the last line of your income statement. And you would expect that number to change every year. So the income tax, unlike the fixed assets, will not grow for every year. It's just going to change depending on whatever your profit is. So the typical way it's computed is a proportion of your profit for that year. So it's not going to change depending on whatever your profit for that year is. The last line that we're talking about is the retained earnings. Your retained earnings is expected to be your accumulated net income from the previous year. So your retained earnings for 2017, starting from 2018, will be whatever income you earned in 2017. Your retained earnings in 2019 will be whatever income you've earned all the years up to 2019, 2018, 2017, and for as long as your business has been functional. Then we have calculations. We have some interesting looking, some not very common, not very popular line items on the balance sheet. We have the inventory, we have accounts receivable and accounts payable. So this is, before I go into the formula calculation, I just want to talk about what these three things are and just explain the concept behind it. So these three things, they are a reflection of your working capital. And a way to explain, understand what working capital means for your business is basically this. So imagine you're running your business and all of a sudden you realize that you need to pay your workers' salaries in the next week. And you realize that you don't have any money in your account. You don't have any cash available with you. So working capital is, but in that business, you can just suddenly come to the realization that, oh, I do have money. I delivered a service to this particular customer, and I'm expecting $500 from them. And then I have some goods in my warehouse that are worth $50 when I sell. So I do have money. I have $550. But I'm also owing some of my suppliers and my vendors. I'm owing them like $300. So your working capital is basically your 550 minus your 300, which is your 250. That's the type of working capital. It's basically how liquid, how soon can you get out cash for your business to meet your short-term obligations. So these are the elements of working capital. Your accounts receivable, your accounts, you start from that, is whatever revenue you expect for that year times your average receivable days all over 365. So pay you your money, and that is your average receivable days. And when you divide by 365 and multiply by your revenue, you get a sense of what your account receivable will look like for that year. Then inventory is, which is your current COGS multiplied by your average inventory turnover divided by 365. Your average inventory turnover is basically how much the value of your okay, I am now, and I'm going to start from the formula calculation. So I did the accounts receivable. Accounts receivable is going to be calculated as your expected revenue for the year multiplied by your average receivable days divided by 365. And then I explained that your average receivable days is basically the average time it takes for your customers to pay up whatever goods or services that you're providing to them. And you average it out. Let's say you're providing services to people that take 30 days to pay up. You're providing services to people that take 14 days to pay up. You do an average of that, and that's your average receivable days. And then you divide that by 365 and multiply it by your revenue to get a sense of what your account receivable will be for that year. So I'm going over all the formula calculations, and I just finished the accounts receivable. The next one I'm looking at is inventory. How do you calculate your inventory for the year? So you have the formula calculation is your current COGS for the year. COGS is cost of goods sold. multiplied by your average inventory turnover divided by 365. And then I was giving an example of, let's say, a fast food business that is basically run by a cook or a caterer who buys food, prepares the food, sells food. So let's say that she takes equivalent of $1,000 to the market every day, buys food, prepares the food, and sells off that food, all the food within that day. So that means her average inventory, her inventory turnover, that's the time it takes to turn over the raw materials that she's put into her business, is 1 day. So her average inventory turnover for that year, her inventory for that year, because you know that your balance sheet is reflecting what the state of your business looks like as at December 31st of whatever year you're reporting in. So you would, by the time we do that calculation of her cost of goods sold, just her material cost, which is $1,000, multiplied by her cost of goods sold, that's $1,000, multiplied by 365, because let's imagine that she's producing food every day of the year. That would be $365,000. And then when we multiply that by 1/365, we'll find out that what we're getting is $1,000. So what your balance sheet is just saying is that as at December 31st, 2018, fast food business A has exactly $1,000 as inventory, which is the correct number because we know that she takes $1,000 to the market every day to buy inventory. So that's what your inventory is supposed to reflect, that as at the last day of the year, how much goods or how much of your services that will be in your inventory or your warehouse or will be waiting to be sold. And inventory typically comprises of your raw materials, your work in progress, and whatever finished goods you have in your business. Okay. And then the last formula calculation I'm looking at is your accounts payable. An accounts payable is going to be estimated by your current expenses for the year, multiplied by your average payable in days, divided by 365. So, like accounts receivable was looking at how long it takes for people to pay you. How long does it take for you to pay people? That's pay your vendors, pay your raw material suppliers, and all of that. And that is calculated by taking your expenses for the expected expenses for a year, how much you expect to spend on rent, on utilities, on advertising, on salaries, and all of that, and multiplying that by your average the average number of days it takes for you to pay up in your business, and then dividing that by 365. And once you do that, you're able to get a sense of what your accounts payable will be for the year. And by the time you plug in all these numbers, you then get a sense of what your liabilities are for the year, your assets are, and your pay. So under your equity, we have investment capital and we have accumulated return earnings. We're expecting that the line of investment capital will reflect the 5,000 seed capital that you're expecting to get from TEF. And you should also reflect any other capital that you're expecting to get as well. And like I also mentioned, I mentioned earlier, your retained earnings is your net income, accumulated net income from all the years your business has been in operation. Then other sections that I have been highlighted as other estimation or optional. Other estimation or optional. Those are things like investments. Investments on the assets, that would be, is asking the question that do you expect short-term investments? Like let's say you get in so much money that like the $5,000 that you're expecting is just in a savings account and you want this money to work for you. Are you going to put it in some treasury bills, or they're expected to be low-risk investments basically. So if you are expected to make any of such investments over the course of the first 2 years of operation, you put that in your balance sheet. The other cost there is prepaid expenses. Prepaid expenses, I like to compare it with accounts receivables when I'm explaining what it is. The money that you have money that you're expecting your customers to pay you. Prepaid expenses is value that you're expecting your service providers to give to you. So that value can be in the sense of like rent cost. If you paid your rent cost for the whole year in January, and you've not used up that rent money. So what's that value? What's that value? What's the remaining value? You put that in prepaid expenses. Utilities as well. Utilities as well. Let's say you paid for internet services for 6 months and you only, as at December 31st of the year, you've only used the remaining money that is yet to, the remaining value that is yet to be realized. That's 2 months worth of internet expense going to reflect in your prepaid expenses. So like I said, accounts receivables is value you're expecting, money you're expecting your customers to bring to you because you have delivered services for them, while prepaid expenses is the value that you're expecting your service providers to bring to you from money you have given to them. Then the next one I'm going to look at is accrued wages. So accrued wages is money that you're expecting to pay your money you're owing your employees. And I'll keep quick compensation. That's basically money you're owing your employees. It's expected to be, depending on the way you run your operation, you would typically expect that by December 31st, everybody would have been paid. But maybe you have employees that are running on some 3 months. So whatever money that you expected to pay them is what goes into accrued wages. Accrued compensation is also follows the same situation. Whatever benefits that your employees, you promised your employees, and they're expecting from you, and has not been paid off as of December 31st, 31st of whatever year you're reporting in. The next line we want to talk about is deferred income. Again, the way I compared, like I compared accounts receivable and prepaid expenses, the same way I'm going to compare accounts payable and deferred income. So accounts payable is money that you are owing your service providers or your suppliers, or whoever has provided value to you that you have not yet paid money for. While deferred income is money your customer has paid to you that you have not delivered the full value of. So let's say you have a customer that wants you to deliver services for 6 months, and in the first month they pay the full amount of money for that service that they're expecting. The remaining number of months that is not yet delivered value or services for is what is going to be in your deferred income. So it's important. The reason why all of these are projected in your balance sheet is to get a sense of for you. It's a good way to plan, so that as an entrepreneur, imagine if you have 100,000 accounts, you will have a sense of you have a sense that this $10,000 is not all revenue. There's a portion of it that is money that I'm owing people. There's a portion of it that is value I'm owing people. So it helps you plan your finances better when you have projected your financials on the balance sheet. So with that, that's the final statement that we're going to look at. And then the next slide that we're going to look at after this is basically common mistakes to avoid when making financial projections. These common mistakes, so we have 4 that we've listed here. Observations that we've made over the course of reviewing financials for entrepreneurs over the course of the year. So the first mistake to avoid the first common mistake is financial projections that are not aligned to assumptions or revenue model outlined in the business plan. So just like I mentioned when I was explaining the 4 steps that you take in estimating your financials, you have to be sure that all your revenue and all your costs outline the impact of all your marketing and operational strategies that you've outlined that you've set out for your business. So let's say in your business plan is showing that you're expecting revenue of $5,000 in year 1, and then in your income statement in your financial sheet is showing that you're expecting revenue of $1 million in year 1. There is a mismatch, there's a misalignment, and that's a problem. So that kind of problem typically comes from not double checking your numbers and not making sure, because one thing that you must keep in mind is that you're telling a story, and when you're telling a story, all elements of the story have to add up. So if you're saying that you're going to get $5,000 in your business projections, in your revenue projections, your Excel document says that you're going to get $20,000 or $200,000, that means your story is not adding up, and that's a point of concern, and you want to avoid losing credibility because your numbers are not adding up. So always ensure that whatever projections you made, the costs that you've outlined, and the revenue that you're expecting, as you put it in your business plan, ensure it's reflected in your financial projections. The second one is unrealistic financial estimations. That's extremely low cost or inflated revenue projections. And sometimes it goes in another direction where you basically want to avoid this mistake because it's showing that you are not too familiar with your industry, which is not a good sign, because you always want to communicate confidence in your industry and in your business. So when you have rent cost that is looking like it is cost of office supplies, it's asking the question, it's making people ask the question of whether you do not understand the implication of utilities when you're running your business. So you want to avoid estimations that don't look realistic. Also, your growth rate must be realistic. Expecting 100% growth rate, expecting 80% growth rate in particular industries is not even realistic by any means. So there are some industries that you're expecting to pick up, your businesses to pick up faster than others, the growth rate to pick up faster than others, and and that should be reflected. Your customer growth rate must be reflective of the industry that you're working in. If you know that customer retention, customer attraction, as in the rate at which people adopt your product, is lower compared to another industry, make sure that your industry realities are reflected in your own projections. The third one is reporting in multiple currencies, which I've seen in the comments already, that already you are realizing that there are multiple currency issues that you need to avoid. So even though there are some formatting in the template that makes it seem that there's one standard currency that must be reflected in all your statements, your income statement, your profit and loss, and your balance sheet, and Formularing is communicating that to you. Ensure that that is what is operational for all numbers that you're putting in. If you're a Nigerian business, you don't want to see 5,000 naira in one place and then $100 in another place, because the impact, even if your numbers are correct, because people are doing a number to number analysis, it's just not going to add up. It's not. It's you again. We want to communicate confidence in what we want to make it clear, communicate credibility that we know our numbers. So once numbers don't add up in one area, it starts to raise concerns about the credibility of your business and credibility of the projections that you've made. So ensure that you're on this area. You are reporting in only one. Decide on one currency that you're going to use and maintain that currency as advised as Formularing for all numbers that you're projecting in your business plan. And then the last mistake, which is a very popular mistake, is this popular that almost 40% of total businesses last year that did not scale through the business plan review stage suffered from this problem. It's an important problem that you need to be sure of, that you need to avoid. Important is a very common balance sheet where your assets do not equal the sum of liabilities and equity. The template that you have been provided has flags and a checklist that shows you when your numbers are adding up and when they are not adding up. So always use that flag. It will show you a green flag when your numbers are adding up, and it will show you a red flag when they are not adding up. So be conscious of that flag and be sure that your numbers add up at any point in time. The balance sheet must balance because it's an accounting requirement. It just shows sound accounting logic. And the other thing that it's communicating, even if it doesn't, when it doesn't balance up, is that the message that is being passed out. Imagine when you have your assets that are more than your liabilities and equity. The message is passing is that you are planning to purchase a lot of things in your business. Those things will come from whether you're going to take out a loan or you're going to ask for more money. That's what you're communicating when your assets are more than your liabilities and equity. And when your liabilities and equity are more than your assets, what it's communicating is that you're planning to go and borrow a lot of money and ask for a lot of money, and you're not going to plug it into value for your business. You're not going to buy assets for your business. So in both scenarios, it raises credibility concerns, and that's one thing you want to avoid. So when you are making your financial projections, always ensure that your assets, when you've made your projections for the whole year, end up equaling the sum of your liabilities and equity. So with that, we're going to go into the answers to the pre-test that was sent out a week ago. So we had a pre-test that was basically looking at a hypothetical business named James Poultry. And we had some questions, we had some statements about the business. We found out the business, we had the cost of running water, cost of utility, cost of electricity that the business requires every month. We also have the cost of raw materials, we have the cost of staff, farm hands, and sales representatives. So the answers to the questions are here. The cost of goods sold for the business is $215, which is the cost of the farm hand plus the cost of the material. Remember that cost of goods sold is material plus labor cost. So it's $215. The wages and salaries is $175. Now, the reason why these questions were asked was that we need to be careful record. So this question was asking, gave us the value gave us the salary of an indirect labor hand and the salary of a direct labor hand. And the temptation when you're calculating wages and salaries is to lump up both costs together. But that must not be done. You must always separate cost of the direct labor costs, that's those that directly involved in production, from indirect labor costs. And then cost of utilities was 80, which majority of you got the answer to that question right. Then the other set of questions was asking around cash, inventory, accounts receivable, accounts, property and equipment, unnamed revenue, accounts payable, interest payable, and all of that. So cash for that business was calculated by all the cash that was received and all the cash that was earned, paid in full, from services paid in full and money received in full in the business. And that total amount came to $6,000. The other cost, at the end of 2017, James had 20 unsold crates of eggs. So inventory was basically that 20 times what the value of one crate of egg is, which is $10, $200. Accounts receivable was money he was owed in his business, and he had an agreement with the supermarket to be paid at the end of every third month. And based on that agreement, when you compute the number of months from May all the way to December, you will find out that he has outstanding payments for 2 months. And the payment for 2 months, where per month he was delivering 50 crates of egg, the payment for 2 months came to $1,000. Property and equipment was basically all the property was able to purchase for his business. That is the cutting and veiling equipment, the sealing machine, and the branding equipment. Unearned revenue was the money that was given to him by the local government that was implementing the school feeding program. The money that he hadn't used up. So that contract started in August all the way to December was 5 months, and he was paid money for 6 months. So the money for that last month, which he had not yet earned, was what we refer to as unearned revenue, and that was equivalent of $300. Accounts payable was money he was owing his suppliers. That was 3 months worth of poultry feed, which was $345. Good number of people got that number right. Interest payable, the low of $1,500 at the rate of 14% that was supposed to be paid up in December 2018. The amount of time that had passed between when he took the loan, that was July to December, was basically 6 months or 0.5 years. Instead, in the question, I was going to use the simple interest computation to determine the interest payable. Doing that, multiplying principal times rate times time, that gives us $105. And then notes payable is simply the loan that he had not yet repaid, which was $1,500. So if he had started repaying the loan, it will be less than $1,500 because notes payable is always money that is being owed. It will not be the money that he borrowed. It's money he's still owing at the end of a particular period. Okay, and with that, we come to the end of the presentation. So we're just going to... Okay, I'm going to just take out the next 10 minutes to review the questions that have been asked, to take answers to... Yeah, okay, take that. Okay. So I'm going to send it. Okay. Okay, so Epafreight Minufong says, how do we build a cash flow statement when we are not receiving any revenue? So like I stated earlier in the presentation that every entrepreneur that has been selected for this develop financial projections, and we know that different entrepreneurs, the 1,000 plus entrepreneurs that were selected are at different stages of their businesses. Some have been in businesses for a couple of years, some are at their market entry stage, and some are just in business idea stage. But with that notwithstanding, everybody is expected to generate projection of their business. So how do you generate a cash flow statement when you are not receiving revenue? This cash flow statement is a projection of the revenue that you're going to get once your business starts operation. So you have a time that you're starting operations. We're assuming it to be 2018 for everybody since we're so far out. 2018 for everyone that is just starting out. But for businesses that have been ongoing, we'll be able to see your projections before 2018. So assuming you start operations with all your revenue, with all your costs, with all that you're expected, all your business is expected to provide, and all the value you're expected to generate, how much revenue are you going to get? What's your price? What's the price of your product? What's the expected volume of your product? If you're a new business, you will give time for adoption, and you probably project like a lower number of customers in your first few months of operation. You project that it will take time for your business, for the word to get around on your business, and for your sales to pick up. So that should be reflected. So everybody is expected to show projections. Whether you're, again, that's why the word is projection. We're not expecting you to put the numbers of what you're seeing now. Even if you're putting numbers of what you're seeing now, we want to see the numbers after the expected investment from Melu Foundation. What are your numbers going to look like? That's the projection we're asking for. So everybody is expected to have projections. So for those that are in business idea phase, it means that you're going to go to the market, go to your industry and get the numbers, get a sense of what the numbers are, what the costs are in your industry, what your expected, what price you can afford to put out for your product. I believe that you all have you all be able to even estimate your price for your product. So you have that number. All you need to do is just estimate what your volume to look like for the first few years of operation, month on month. Okay. So any other? Yes. Okay. Are we expected to produce your tax identification? No, not at all. Pascal Chidebere is asking if we're expected to produce tax identification. Not at all. All the financial templates want you to put is your tax rate applicable for your business in your country. Like I think in Nigeria it's 30%, that's the expected income tax. And I know in other countries it will differ. So whatever your income tax rate is, you put in that number in your assumptions tab for the year. And that taxation number that it computes, you're going to put it into your income. You're going to put it as your income tax expense for the year in your income statement. And you're also going to put it as your tax payable in your balance sheet. That's assuming that you have not paid your tax as at the end of the year. So the reason why tax payable is showing up, it's just dependent on, it's an estimation based on how the tax calendar runs in Nigeria. Nigerian businesses are expected to file their tax returns for the year on 31st of January. So the assumption is that as at December 31st, you have not yet paid your tax. So it's going to show up in tax payable. But if you're in a country where that is not operational, you don't have to put in tax payable. So that tax, after you compute it from the assumption sheet, after you compute it from into the cash flow statement, you take that number and you put it where it's applicable in your income statement. You also put it applicable, if it's applicable, in your balance sheet under taxes payable. Okay. So, is there any other question? Okay. So does the startup cost on the Excel sheet include both CAPEX? I believe that there is a different schedule. You need to scroll down on your assumption sheet and check. There's a place where you're supposed to put CAPEX cost, and it's clearly stated out. Let me confirm by looking at it. Oh, but to your question, startup cost includes both CAPEX and operating costs. So if you don't see a separate place where you're supposed to put in your CAPEX costs, you put in all your startup CAPEX costs in that startup cost table on your assumption sheet. So that's my answer to your question. So you do both startup costs, CAPEX and operating costs. Yes, it does. Okay, we've already answered. Yes. Okay. Okay. Okay, so it's asking for the statements. So the statements that are being used in this presentation they're just snapshots of what you already, they are dummy numbers. It's stuff you already have, it's stuff that it just came from your financial statement. So it's not, it doesn't have any additional value, but I believe the presentation will be shared. Yeah. Okay, so we have another question. Okay. You can see me. Oh, can you hear me? All right. Sorry, I didn't know I was back on. Okay, so I'm just going to continue with the question that Florence Ejoma asked, and that is distribution expense part of cost of goods sold in income statement. So distribution expense, I believe what you're referring to is cost of sending out your finished product to your customers, that cost is not included in cost of goods sold. But if you mean the cost of sending your raw materials to your factory, which is your logistics or supply chain cost, that's the only kind of transport cost that should be reflected in your income statement. So distribution, that cost of getting your goods out to your customers, is not included in your cost of goods sold. You will come up under expenses, or under, you can get another line for it, like transport expense or distribution cost expense. Okay, so it's not included. It's not included in cost of goods sold, but it will be included in the expenses. You will put it as part of the expenses. That's the second section of your income statement, the bottom section of your income statement. Okay, is there any other question?
Yeah.
Okay. Then I see something very quickly around the rounding up of the figures in the Excel template. So it's a format on the Excel template, and it's don't let it bother you. There's no cause for alarm. Anyone that needs to get your financials can always click in and see your actual numbers. So don't be too bothered if your numbers are being rounded out, because it's just the way the template has been set up. So it does that, just ignore it and build out your financials the way you want to build them. Do you have any other? Okay. Oh, you spent it. Or do you want to just go to showing up on Okay, I can from here. Oh, I can finally see it. Okay, so there's a question from Joseph Umo. What was the first and the second one? Said I want to for this one. Okay, so just what you're going to do, so that don't let the template setup bother you too much. What you're going to do, I believe all your product range stem from the same line of services. So if you average out your price for your 3 products, average out your except volume for your 3 products, and just put that number there, we understand exactly what you're trying to communicate. So, because even though the general idea is that we're funding a business idea, and that business idea might consist of a range of products, but what the financials is asking is trying to establish is that, basically what I'm trying to say is that the financials for the 3 different products, the financial implication will still be the same. So you just aggregate all the expenses involved in the 3 products, aggregate the revenues to be expected from the 3 products, aggregate the volume and price, and put that aggregate and average out the volume and price, and put the average in where the template is asking for price and volume, and then continue as expected. So don't struggle for entrepreneurs that have multiple products. Just put an average of your volume, expected volume and expected price for those products, and put them in base volume and base price. Because our understanding is, even if you have up to 20 products, you're still going to incur the same, you're still going to, it's one business that is incurring cost of transport, cost of sales, cost of salaries, cost of rent, cost of utilities, is one cost. So the problem is about the volume and price. So just put an average of those. Average out your volume and your price and put that number in there so that you can plug in revenue and sales, revenue for your business. So I have a question from Diana that is saying your projection should be 15 years or can it be 10 years? So the template is giving you the opportunity to project for 15 years. But basically, all you're going to be assessed on is your first 5 years projection. So whichever one you want to do, you could do. Whichever one is convenient for you, you could do. But the first 5 year projection is the one that is important for the people that are going to be reviewing your financials. So focus on first 5 years. That's the answer to your question. So focus on the first 3 to 5 years. Any other question?
Yeah.
So is the seed capital the same as equity injection? Yes, exactly it is. But for a business where you're expecting some other source of equity, you can add that additional source of equity. So, Uluwabukola Akinsewe, seed capital is the same as equity injection if that's all the equity you're expecting in your business for that year. It's exactly the same. And it's very Ogbona is asking, how do I determine growth rate and volume growth rates in percentages? So you are going to use what is applicable, look at your industry and look at your business. So this is your own estimation. You are going to take a look at the business you want to offer, the service you want to offer, the product you want to offer, and then do an estimate that what growth rate do I expect for this business? For volume growth rate, how soon do I expect to increase my rate of production? That is your own estimate, and that's based on all the assumptions that you put into your business. So there isn't any particular formula to do that. That's going to be based on what you've been able to, yes, now it's better. What you've been able to, all the assumptions you're able to put in. And it's also going to be based a bit on your industry. So for some particular industries, you know that you cannot, if you are growing your volume, it's going to impact your expenses significantly. So you cannot grow it by too high a margin. So you know that maybe you're expecting 5% volume growth rate because cost to produce is so high, and I'm sure I've already recouped all the money that I have put in, and revenue is not even coming quickly. So let me just project my volume growth rate to 5% or 10%. That's an estimate you're going to be able to do. You have to do for yourself, depending on the assumptions that you made for your business. So a very gonna that calculation has to be done by you, depending on it's going to be done based on the assumptions that you've made and based on what is applicable in your industry and your business environment. Benjamin Masige, if my business leaves a loan facility with the template, doesn't reach payments with okay. Repayment with amortization. So there is no linkage. There's no linkage. The balance sheet, which is where you're going to reflect your amortization of your bank loan. There is no linkage at all. That balance sheet has no formulas at all. So you are going to calculate your amortization by yourself and then put in the final numbers into the balance sheet. I hope that is clear. So when you are showing repayment on your bank loan, except you're referring to the cash flow statement. Okay. So the balance sheet is not. So that's basically, maybe the question is not clear because I'm wondering which of the sheets you're having problem with. Because when you say amortization, I'm thinking about the balance sheet, and then the balance sheet doesn't have any linkages whatsoever, so there should not be any problems in putting in your amortization into your balance sheet. But if you're referring to the cash flow statement, it's coming in. All you need to do is just build in the assumptions into the assumption sheet, and it will flow in. Ubong Charlie, percentage of rent utilities that we have to impute in second table. Okay, so let me try and break this down. About Ubong Charlie, your question. So percentage, which is, I believe you are referring to inflation on rent and utilities. So there's a place in your assumption sheet that you're supposed to put in your expected inflation rate year on year. So expected inflation rate on rent will be, if you are paying $10,000 for where you are now, how much you are going to have to pay? Will you pay that $10,000 for the next 5 years, or do you think that based on certain factors, maybe macroeconomic factors, maybe whatever your economic situation your country is going through, do you think that that cost is going to increase? If you think the cost is going to increase by 11,000, so whatever the rate of increase is between 10,000 and 11,000, that is what we're expecting to reflect in your growth rate for year one. If you're expecting to go from 11,000 to another maybe 15,000, reflect that rate of growth. So that's what that is. That's what it is. So when you ask that if this percentage that reflects the total amount to start off, yes, your percentages are based on your baseline cost. Your percentages will be based on your baseline cost. So, any other questions? Which one is it? Move on, Charlie. Cash cow, no problem. Okay. Okay, Pascal Chidiebere, you're asking about if you need to put cost as rent. You're not renting a facility, your rent is zero. So that rent cost only applies for people that are renting. If you are not, incurring any rental cost, your rent cost, the value you leave is just zero. So no need to put that number if you've already acquired where you are working, where your business is based. Miley, I have seen income statements have depreciation for income statements that have depreciation for equipment and vehicles under them, So how do you calculate? So Lungile Miley, if I got that right, you are asking how you calculate your depreciation cost for equipment and vehicles. So there are different ways of calculating depreciation, but because for purpose of simplicity, you can just apply the straight line depreciation. And straight line depreciation is basically telling you to make an estimate that if you, let me take for example that you bought a vehicle for your business and you spent $50,000 buying that vehicle. How much are you expecting to sell that vehicle by the time you are done using it? That money is what we call the salvage value. Let's imagine that you're expected to sell off that value when it's $5,000. So how long do you expect to use that vehicle for? Let's assume that you want to use it for 10 years. Your depreciation will simply be your cost of purchase minus your salvage value divided by 10 years. So if you purchase it at $50,000, you want to sell it at $5,000, and you are using it for 10 years. So that's 50 minus 5, that's what $5,000 divided by 10 years, that's 4,500. So for every year, your cost of depreciation will be 4,500. It's just that same number you're going to put in. You can use the straight line depreciation. So you just put in 4,500 for year 1, 4,500 for year 2, on and on till you reach year 10. So that's how you're going to calculate your cost of depreciation. So use straight line depreciation to calculate whatever depreciation you're going to experience in your business on your business asset. Is there any limit for number of pages? You have a Israel Mwalaye. there is a TEF business plan template that you have. So once you follow that template, it would guide you on how much content you're supposed to put in each section. So technically there is no limit, but we are expecting to be as concise as possible. Just be very straight to the point, but provide all the information. So there really is no limit to the number of pages, so long you are providing the content as set out in the TEF business plan template. There is no limit, but just be sure that you are following the order that has been set out in the business plan template. Janet Mambo, what's the exchange rate you should consider for? Is there any? So there is a. I don't know if you can use oanda.com. The OANDA. It's a website that helps aggregate currency, aggregate different currencies and exchange rates of currencies. So all you are going to do is just use the number that is applicable for the Uganda exchange rate as at the time you start your business, and you can always refer to it, because when you have a currency that fluctuates every day, just all you need to do is just be sure that whatever exchange rate you are applying is from a relevant, from a okay. So maybe she's referring to when she has to convert, like she got the cost from, if you got the cost from in dollars and she wants to convert. But another thing I want to remind you of is that remember that you are reporting all your numbers in Ugandan currency. So I'm not sure that there's any need for you to have an exchange rate. So I'm answering this question assuming that maybe you want to convert cost of a particular raw material or equipment that you found in dollars and you want to convert it to Ugandan currency. So use an exchange rate from a credible source. A credible source is one credible source you can use is oanda.com, oanda.com. Use that exchange rate. But remember that you are using the Ugandan currency to project all your financials. Okay, so what you are going to do is that your Mexico is asking if you are expecting other sources of equity. So you know what year they're expecting that additional source of equity, right? If you're expecting it in year 2, you will ensure that that additional source of equity is reflected in your cash flow statement, in your money gotten from investing, and you also ensure that it's reflected in your balance sheet for that year, in that your investment capital for that year. So just ensure if you are reflecting whatever additional equity you are expecting, note the year that you're expecting it to show up in, and ensure that it's reflected in your equity numbers for that year. Your equity numbers on your cash flow statement and on your balance sheet. So Nicola, I've answered your question earlier. The growth rate assumptions are based on there's no formula for it, because you are entrepreneurs from different industries and different countries. So there isn't one formula that can work for you, given the diversity of entrepreneurs that we have on this program. So you have to use your assumptions. You have to compute that for yourself based on two major factors: your industry reality, what is applicable in your industry, and the second factor is your assumptions, the assumptions you made for your business. If you put in a lot of assumptions on your business based on, because you want to differentiate, you want to be different, you want to have a cutting edge business. The things you put in to bring about differentiation in your business, it might have impact on how quickly people are going to adopt, customers are going to adopt your business, adopt your products and services. So ensure that your industry numbers they are weighed with your assumptions, your business assumptions. And once you weigh both of them together, you'll be able to start getting a sense of what your numbers should look like, what your growth rate should look like for your business. So we're not expecting a global growth rate for the business, for any business. It's going to be dependent on your industry and your prevailing factors. So Obi Amuzu, your total liability and stakeholder equity, like I mentioned earlier, the balance sheet has two flags, a green flag and a red flag. So it would show up a red flag when your assets are not equaling your total liability and stakeholder equity. So once you see that red flag, it's telling you that you need to go back and check your numbers and be sure that your assets are equaling your liabilities and stakeholder equity. So that red flag is a quality check for you, so that you know that you are putting the right numbers and your balance sheet is following accounting logic. Emmanuel Sylvester, global inflation constant for projection. So there is no, just like I said, because we're operating in different countries, there is no global inflation rate at all. So what is prevalent? Usually, for Nigerian businesses, you can look at the Bureau of Statistics and look at what they're projecting as inflation for what they have projected as inflation to guide you. And other countries, your Bureau of Statistics or your whatever agency or MBA is in charge of taking the numbers and bringing out your macroeconomic numbers, your GDP numbers, your CPI numbers, and all of that. Use them. Refer to them to get a sense of what your inflation numbers are for your business. Your inflation rate is, sorry. Okay. Maximum number of pages, we've already asked. There is no limit. Just be sure that you are complying with the TEF template. There is no number of questions. So, Hellman Emmanuel, the template is only allowing you to make projections for 1 year for your income statement and projection of 2 years for your balance sheet. So you just need to just follow just fill the template. You might not need to make out a 5-year projection for your income statement. So just use the template as your guide and how long you need to make your projections out for. So that's my answer to Hellman Emmanuel Bazumbura. So do we split cost of rent that is paid in bulk, like 2 years upfront payment into monthly input to profit and loss statement, or input all of it in the first month? So split it up in your income statement. Split it up. Just split it up. Split it up so that the general sense is that at the end of the year, it's going to come to that very number that was paid in bulk. So because we're making a projection, just so that for neatness and for statistical purposes, let it be split up. But when you are reporting your financials in your business, you would typically report it in the period in which it was incurred, whatever financial was incurred. William Ashidi. Okay. So Bukola Akintewe, maybe my startup cost in assumption has twice on the cash flow. It adds up to the intention. So Oluwa Bukola Akintewe, what I'm going to say to you is that as long as you are sure that you put in the right assumptions into the assumptions tab, whatever is throwing off, don't let it bother you too much. Just be sure that you are putting your right assumption. It's saying it adds up twice on cash flow. It adds to my equity injection. So what can I do? No. So be sure that you have separated your capital expenditure from your startup cost, so that it does not add up twice. I wish I had the template in front of me, but I don't have it here right now, so I cannot refer to it. But just be sure that you have split up your cost, because the template has already been designed to account for your capital expenditure as your cost of investing. So remember that your cash flow statement, it groups your cost into 3 categories: operating, investing, and financing. In your cost of investing, that's where your fixed asset and capex costs are going to feature. So if you added So, okay, I think what you have done is that maybe you've added your capex cost as part of your startup cost, and then you put your capex cost somewhere else. So what you need to do is remove your capex cost from your startup cost. I think I answered a question earlier to you that showed that you should put it up. But now I'm realizing what your scenario is. Remove it because you're already going to put your capex cost somewhere so that it does not double count. Remove it from startup cost. If you've already put it all your capex cost, if you already put them as in the capex cost area, remove them from startup cost so that they don't double count. Because startup cost is going to go into your cash flow from operations, and your cash flow from operations should not be reflecting your capex. Sure, Malago. So note that the template is, you mentioned that it's not showing more than a particular amount. So note that the template is rounding up your numbers, which is not a problem. So long as you put in the right number, just don't let that concern you too much. So I think that's what you're referring to. If the template is rounding up your number, don't let it bother you. So Olatunbo Olatunji, you are talking about a business that renders training that estimates revenue on a quarterly basis. Then how do you determine that on the financial template given? So what you are going to do is, for purpose of simplicity, split up those costs, even though you realize them on a quarterly basis. Split them up so that you can. So if you have money that comes in every 3 months, split up, divide that money by 3, and then put that money in to each month, so that at the end of the year we have the total cost add up to give the same figure. So I think okay. Yeah. So say that at any run, I believe that the templates, there are sections on templates that don't show projections for up to 5 years. If you don't show like your balance sheet, it's just what is mandatory is showing projection is the projection for 2 years. You do projection for 2 years, fine. If you do up to 3, 5. Yeah.
All right. So it's almost 6 o'clock, and so we have now come to the end of this webinar session. Thank you for your interactions and your questions and all of that. And so that will be all. Bye.
Yeah. Hi everyone, this is Jite and Binta. Thank you so much for joining us. We apologize for all technical issues.
Yes, and thank you for your participation. We have tracked your attendance, so well done on coming this far in the program. Just to be sure, the recording of this video will be uploaded within 24 hours, and all your questions, if they haven't been answered here, we'll provide FAQs on the MLP, so please don't worry if your question has not been answered today.